So here we are in week 3, Big Bad Fees of our Super 7 webinar series. Your superannuation statement is trying to talk to you. What is it saying? And I have with me Monica Ponmoon from Bantax Financial Solutions. So Monica and myself are both from Bantax, but I'm from the accounting division and Monica's a senior financial planner with Bantax Financial Solutions. And I specialise in businesses on zero and investment property owners, particularly with over 30 years experience in business. Monica, do you want to give a little bit of info about yourself?
Thanks, Colleen. Okay, so my name is Monica Ponmoon, Senior Financial Planner with Bantax Financial Solutions, delivering honest, holistic advice to my clients and working with my clients and their other professionals such as accountants and solicitors to reach their best financial future. I've got 30 plus years in financial services, both locally and abroad.
And the usual disclaimer, this is all of a general nature of advice, and if you want advice on your particular needs, Monica's available if you don't already have a financial planner that you trust. This is basically about the public super funds, not necessarily SMSFs, because self-managed superannuation funds has its own set of, let's face it, many rules. And also that laws changing all the time, and please seek advice before making any important financial or tax decisions. So this is what we're covering. So we've been through webinar 1 and 2, and now we're on to Big Bad Fees. How much is too much? And we'll be covering super performance, insurance in super, the tax acts, and estate planning and super in the coming weeks. So let's just do a bit of a recap of weeks 1 and 2. So what have we covered so far? Why we care about our clients' super, because so many people haven't kept track of their super, and sometimes in a lot of cases their savings are being eroded away, and we'd like to help people. And with life expectancy info that we looked at in session 1, you know, we've all got long life expectancies, so it's very important that we have enough savings for the future. And we looked at superannuation balances and age, and basically women have less balances in super than men in just about every age group that we looked at. Last week, Monica looked at ways to find out what super you have and how to compare your super funds using CanStar or ChantWest. Even if you only have one super fund, it's still interesting to see how it's going compared to some of the other funds. We looked at how to consolidate your funds and some factors to consider. And we looked at action points. Make sure you can log into your super funds and see what's happening with it. Look at your mailed annual statement for the last 2 years. Do you only have one super fund now? Have you made any decisions or taken any action since the last webinar? So use the information in our webinars as we work through these sessions to show how you can improve your financial future. So don't let your superannuation savings fade away. So Monica, over to you, all about fees in super funds.
Okay, so having superannuation is compulsory and something that we all have to have. So paying fees when it comes to superannuation is something that we cannot avoid. There are a number of fees that will be paid through superannuation. Some of those will be shown on your super statement, and some of them are what we call indirect fees that you don't actually see on the statement. So we can have a look at all the different types of fees that you might be paying on your superannuation. The first one is administration fees. Generally speaking, administration fees are the fees that are paid for your super fund to have somebody sit in an office and do the general day-to-day administration or data capturing for your superannuation fund. That could include putting in data into the system so that when you get your annual statement, everything is reflected on there and it is showing correctly. Administration fees would also include for your super fund accountancy fees, because like everyone else, they do have a tax file number and they do have to lodge an annual tax return. Our next fee is investment fees. So investment fees are the fees that are paid to the investment managers who manage the investment of your superannuation fund. Even if you haven't made an investment choice or selected where you want to have your money invested in your superannuation fund, there will be a default option that is normally applied. These are normally done based on age, and they will also have an investment fee. The investment fee is paid generally before your fund declares the annual return on your superannuation investment earnings. So for example, if your fund generated a return of 10% and the investment management fee was 1%, 1% would be paid to the investment fund manager, and the superannuation fund would declare an annual return of 9% to its members for that particular investment option. Different investment options may have different fees. Contributions tax. Contributions tax is paid on contributions that are received into superannuation, such as your super guarantee contributions that are paid by your employer, so the mandatory 9.5% that they have to pay, or any salary sacrifice contributions that you may be paying. This is generally 15%. In some instances, if you happen to go over our contribution caps, which we'll talk about in the Tax Act week, there may be additional taxes that apply. But for most people, it's a 15% that would apply on any contributions received. Those are before tax contributions, not the after tax contributions. Insurance premiums. So with our superannuation, quite often we have insurances that are bundled inside our super. More often than not, these are death and total permanent disability. In some instances, you may have some income protection insurance too. No insurances will come from nothing, so you do pay for these, and those premiums are paid from your superannuation balance. These can vary between funds and can also cost quite a bit. Exit fees. Typically, if some of our industry funds will charge an exit fee. So if you were to, say, have more than one superannuation fund and you wanted to roll them all together into one, you may find that one or more of your superannuation funds will charge you a fee to do that rollover into your fund that you've chosen. Okay, so under new legislation that has also come into play, the exit fees have generally been removed on superannuation funds. Switching fees. So if you were to select your own investment options within your superannuation fund, instead of the default one that they will generally have you invested in, you may be charged a switching fee. Normally, most super funds will allow you to do at least one switch or one investment switch per year without charging you a fee. But if you go over that more than one investment choice, they will start charging you a fee. These vary from fund to fund. Okay, and as we can see, there are some other fees there that may apply for contribution splitting, Family Law Act information requests, Family Law Act splitting account fees, financial advice fees for transition to retirement or pension services. Those fees are generally a little bit out of the ordinary and wouldn't apply to most people. So by the time you retire, we need to make sure that your Tiggy Super Bank is actually growing and not being eaten up by the big bad wolf of fees. Who will win when you retire? How do you check to see you're getting the best bang for your buck? One of the important things or documents that you would have received when you joined your superannuation fund would be a product disclosure statement. On the screen, you can currently see the current product disclosure statement for Q Super. There will be a table of contents in the beginning, which will tell you where you can find the fees and costs for that particular fund. In this instance, we've gone to have a look at that, and we can see how they've laid out the different fees. They show us what the investment fee is. As you can see, for their different default options there, different fees apply for different options. They also have an administration fee, which is shown as a percentage there. In some instances, depending on your fund, this may actually be shown as a dollar amount, but it doesn't mean that because it's a dollar amount and easy to understand that it's actually cheaper than a percentage-based fee. So best you do a like-for-like comparison. There may be a buy-sell spread, a switching fee. In this case, there is no switching fee. Advice fees, unless you get specific advice and they agree to pay a fee to your financial advisor. Other fees and costs, as I said, there are some indirect costs that are involved, and these are shown there pretty much as an administration fee in inverted commas for the investment fund manager for those particular investment options. This is over and above the investment fee that is shown at the bottom of the previous page there.
So Monica, would you say that everyone reads these PDS statements from cover to cover?
In my experience, Colleen, the short answer is no. It's very seldom you'd come across anyone who has paid attention to the product disclosure statement. And it really is an important document to be across and understand, because it does give you quite a bit of information in there, in particular around the investment options and most importantly, or rather importantly, the fees and costs, so how much it's actually costing you to have that fund. Okay, so not all super fees are created equal. Last week we had a look at CanStar and we had a look at how you can compare different Australian superannuation funds. This week we're using CanStar again to have a look at superannuation funds, comparing the 3 highest in fees versus 3 lowest in fees. And below there are the parameters that were used for a typical balance for someone aged 18 to 29 with a rather small superannuation balance. So those would be our 3 cheapest ones. As we can see, with the 3 cheapest, there is quite a bit of variance in the amount of fees charged. But if we have a look at the column that's got the plus 0.587 or the plus 8.45, that shows us the investment performance for those particular options as an average over 5 years. So having a look at that, we can see that even though you got the cheapest one, you're not necessarily getting the best performance on your money. So is it necessarily the best thing to have the cheapest one? Now let's have a look at what happens when we look at the most expensive ones. The 3 funds shown there as the most expensive are all what we would call retail super funds, so they're not industry funds. Again, we can see there that the fees vary quite a bit, by just over $100 in some instances. And having a look at the performance figures there, we can see that they're actually a little bit lower and in some instances a lot lower than those of the cheaper funds. So again, doesn't mean that because you're paying a higher price for your superannuation that you've got the best deal or the best performing fund. We need to have a look at exactly how those are performing. In this instance, it would have been the default balance option across all 3 6 funds that has been used as the benchmark for the performance in that particular selection that we've done there. So in this instance, you'd probably be looking at using not an industry fund, we'd be using something like the ANZ Smart Choice Super, because that gives us a reasonable amount of fees, not too expensive, but a good performance. But again, you need to have that, tailored to your particular needs. And this is just general advice, and we're by no way, shape or form endorsing any of the funds on the screen there.
No, but that's a huge difference, isn't it, between the most expensive fees and the cheapest fees?
Yes, it is. You're looking at over $700 or close to $700 in some instances there. So yeah, a really big difference. And when you factor in the performance difference as well and compound that over the lifetime of your superannuation, which could be 30 or 40 years, it would make a huge difference at the end of the day.
And if you're not paying attention to fees, the wolf could win out.
Most certainly he could. And that's why it's important to be across your superannuation and understand what it is costing you. Moral of the story, and remember our tip from last week, cheaper isn't always better. Okay, so we're having a look here. And this is a chart that we used last week for working example, showing the difference between having 3 different superannuation funds and consolidating those into one and what that would look like over a period of time. So if this was our starting position, what would it look like after 12 months? So after 12 months, we can see that's not a huge difference in the savings in fees that we've made or the difference in moving to a reasonable superannuation fund. We can see it's not huge, but what does it look like when we extend that out even a little longer? After 10 years, it's almost $20,000 in difference. So $20,000 in your pocket working for you harder and longer.
And that's only after 10 years. If we look at the next slide,
Yeah.
This is taken over a longer period.
Yeah. So what this one's done is taken the same balance of about 60,000 using the annual fees, same rate of return of 7%. And we can see that the difference on those two funds with the same starting balance amounts to about $26,000 or close to $27,000 actually after a 30-year period. So very important that even a small difference in fees does add up over a long period of time. Does size matter? Okay, now there has been a study done by SuperGuide, and it does show that evidence of economies of scale is compelling. Larger funds are strongly associated with lower average costs, purely because they have greater bargaining power when they go to their investment managers or administrators and are therefore able to get their costs lower. There is a lot of money invested in superannuation. If you look at the slide now, you can see there's over $2.6 trillion invested in superannuation, and some of that is yours. At the end of June 2018, 187 funds were regulated by the authorities. The largest fund assets were worth around 145 billion, with the smallest fund just 744,000. So we can see there is quite a lot of variance between the size of different superannuation funds. When an inquiry was run by the Productivity Commission in Australia in 2018, it found that with superannuation, it can pay to be with one of the larger funds. So don't assume because you're in a top-rated fund that you will get above average investment returns.
And we saw that in the CanStar example.
Exactly right. So always important to do a bit of a health check on your super, just to see how it's stacking up, because positions and things do change each year or every couple of years. So what can we do to minimize fees? Well, firstly, consolidate your funds if you have more than one. Unless there's a really compelling reason for you to have more than one superannuation fund, it is always a good idea to consider and look at putting them all together into one basket. Makes it easier for you to keep track of it and know what's going on with your money. Compare your funds. Use CanStar as a starting point to check if you're paying too much for your super savings. As we've seen in the examples, fees can make a big difference over a long period of time.
And we apologise for the image there in case it's upsetting some of our viewers, but there is a reason. Because the government say they have a solution.
But do they?
Dun, dun, dun.
Protecting your super reforms. This was something that the government introduced earlier this year, or at the start of this financial year, the 1st of July 2019, in an effort to help preserve superannuation for a number of people. So what it has done is it's had a look at all superannuations that have balances under 6,000 and said, well, what can we do to stop people's super from being eroded by high costs? In most instances, you might find that you may have 3 or 4 superannuation funds that have small balances, and this is the category that you may fall in with. All of those, you're paying administration fees, insurance fees that are being or eating away at your balance. So in February this year, they passed this legislation to be enacted on the 1st of July. It cancels insurance for inactive members, so where no contributions have been received on a superannuation fund for a period of 16 months. What this means, though, is, yeah, you're not going to be paying those insurance premiums, so your superannuation won't be eaten away by it. But if something were to happen to you, you may not have the insurance that you need, and your family could suffer financial hardship as a result. There have been some changes to fees. As I mentioned before, the exit fees on superannuation funds has now been removed. So when you want to roll over your superannuation and put it all together in one, you won't be charged a fee from any of your funds when you exit. It does give some new powers to the ATO to transfer and hold inactive low balance accounts temporarily. So if your superannuation balance is below $6,000, it will be transferred to the ATO and held in an account until such time as you look for it or claim it. With the ATO, there aren't any administration fees, and your superannuation will earn interest based on inflation for as long as they hold it. And when we consider inflation's only running at around 2 or 3%, oh, actually not even, that's their target. It's currently running at about 1.3%, I believe. that's not a whole lot of interest that you're earning on your superannuation. If you use your MyGov account, you can actually see a number of superannuation funds that you have. Your tax accountant will also be able to have a look-see when they use the tax agent portal to see if there are multiple superannuation accounts linked to your tax file number. This does include self-managed super funds, assuming the self-managed super fund has submitted its last tax return. What is interesting is that it does show the past couple of years, so you're able to see how your superannuation has grown over a period of time. And this gives us a little green heart to show that we're doing something to save our super. Okay, so fees will change in two ways. So as said before, our exit fees are now removed from all superannuation accounts, and administration and investment fees will now be capped at a maximum of 3% for superannuation accounts where the balance is below $6,000. 3% of $6,000 is still a fair chunk of money. As far as insurance goes, again, in an effort to preserve superannuation, the government has introduced the reform called Protecting Your Super, and this prevents inactive super accounts balances being eroded by insurance premiums. So some super funds will cancel your insurances where there's been no activity on your account for 16 months. Some super funds will contact you before the 16 months to check whether or not you want your insurances cancelled. So if you want to retain your insurances, it's important your superannuation has the correct address for yourself. So important to keep your address up to date with all your super funds.
Especially if they go overseas.
Yep, definitely.
Mm.
Okay, another point to consider is if you do happen to have a small superannuation balance, so a balance of $6,000 or more, and this is moved across to the ATO, your insurance inside that superannuation fund will automatically be cancelled, and your family may be left exposed as you may not have the insurance you thought you once had.
So in preparing this webinar, we thought about the 16 months, and 16 months sounds like a decent amount of time, but some people have quite low balances, and to give them a start, by 16 months, their superannuation balance could erode away. So here's an example of a low-income earner and how this new legislation could have helped them over the past 2 years.
Okay, so this is a young person, aged 25 years old, earning a reasonably low wage of $22,000 per annum in a non-professional occupation. Has 2 superannuation funds. Industry Fund A was a fund that they had and had stopped contributing to when they joined the new employer who established Industry Fund B for them. If we have a look there, we can see that the starting balance for Industry Fund A was just over $1,000. But once we add in our administration fees or subtract our administration fees, our insurance premiums, add the investment earnings, in fact, the balance has actually reduced to just under $900. The investment return averaged over 5 years for that particular fund was 8.8%. In Industry Fund B, where contributions had been received, we can see that the investment earnings there weren't much because the balance was really low. We take out our administration fees, the contributions tax of 15% that had been paid, insurance premiums that had been paid, and the resulting balance at the end of June this year was just shy of $6. Investment return for that fund averaged over 5 years was 9.49%. If we look at the CanStar estimate for those particular funds, we can see that fees should be around $354 or $351, which means over 16 months, the difference in those balances would be quite substantial. Industry Fund B would have a 0 balance, while Industry Fund A would reduce quite significantly again. So even over a short period of time, such as 16 months, we can see the impact that this would have.
Plus they had 2 lots of insurance premiums going on.
Correct.
Mm.
Yeah, so pretty much doubled up on all their costs, their administration fees, insurance premiums.
So the good news is with this person, isn't it, that they've now consolidated their super and already it's starting to go up a bit more.
Yeah, this is true. They have done that and they are starting to see it growing instead of being whittled away and eaten up by fees.
Mm. So if you're attending and you think, oh, this doesn't affect me because my balance, my partner's balance is way over 6,000, you might have children, you might have family members, you might have friends that you talk about super with. It's amazing how many people don't have their super consolidated and don't compare the fees and the returns on their fund. And it's just so important because, this person could have had virtually nothing after working for 2 years.
Mm-hmm. So yes, always important to do a health check on your superannuation, no matter where it is. Smart tip number 2 this week is a 1% difference in fees now could add up to 20% difference over a period of 30 years. And that's largely due just to the compounding effect of investment returns, so having more money working harder because you're paying less fees. Our actions for next week. Review your fees on your superannuation. If you haven't consolidated your super, ask yourself why. There may be a valid reason why you haven't, but certainly examine that reason to make sure it is truly valid. Talk to family members and friends. Surprising how many people aren't taking notice of their future savings. Super reforms have started, but 16 months is still a long time, and fees can do a lot of damage in that period of time. Make sure your contact details are up to date with your superannuation fund. Not only your mailing and residential address, but also your email address. We're seeing more and more super funds using email as a form of communication with members. Register for next week's webinar, Super Performance. Is it?
So next Tuesday, 5th of November, 6 p.m. Queensland time, Super Performance. Is it? So Monica and I would like to thank everyone for attending. We'll be back next week with Super Performance, and the webinar series finishes on the 26th of November. So we'll send you out an invitation to the next super session, and thank you very much for attending and have a great night, everyone.